be covering the theory of cost and production. Here we'll try to look at the cost concept and production theory. We'll look at the cost output relationship. We'll try to understand economies of scale, right? Then we'll move to the concept of cost control and cost reduction. Why? Because from the production perspective, when we are talking about, organizations controlling cost, or organizations, ensuring that they meet their production capabilities, cost happens to be an important concept. Managerial uses of the production function and the indifferent curves. Okay. Now, in between, while we are discussing these topics, you may come across, a few concepts that might sound little difficult, but don't worry. Please do help you understand those concepts better. All right. Okay. Uh, Now, the primary question that we answer normally for any business, right? So, suppose if you happen to start your business today, or if you happen to, or if you plan to start a business very soon, the first thing that will come to your mind is obviously answering the question whether you want to go with a product or whether you want to go with a service, right? Now, once that question gets answered, whether I start a product or I start a service, the second most important question for you in a business is to answer the question that what am I going to price my products at, right? So at what price do I want to sell my products, or if I'm planning my production capabilities, the most important question for me to decide my profit or my revenue is to understand what my cost is. So just understand these concepts are interlinked, and when we talk from the perspective of production, or when we talk from the perspective of how businesses make their decisions, an important concept that we need to understand here is total revenue. Now, total revenue is what? It is the total amount that the firm or the business receives from the sale of its output, right? Now, what I've talked about here is the sale of the output, but where is this output coming from? Obviously, this output is coming from the processing that you do. And where do you do that processing? You do it on your raw material. In case of your services, you apply your processes to make sure that whatever product or service you're trying to sell, it is deliverable, right? From that perspective, we understand the concept of total cost as the market value of inputs that a firm uses in production. Now, what do I imply, or what do I mean to say by when I say the total cost concept? Now, understand, when we are talking about inputs, right, we need to understand the value of market cost. Why market cost or the market value? Because as a as a manufacturer yourself, or as a seller yourself, I'm sure when you procure raw material, right, you procure that raw material at a cost, and where is that cost coming from? That cost is coming from the market value of the product or the service that you are procuring, right? So that is why when we understand our total cost, we need to understand the concept of market value, and with respect to all the inputs that you are consuming in the process of your production. And finally, we know what loss is, but normally when we talk from production perspective, or when we talk from why companies do business, or why do organizations aim for, so obviously the aim is profit, right? And how do you calculate profit? You calculate profit by subtracting total cost from the total revenue. If the reverse happens, it's a loss, right? Or rather than a loss, if it happens repetitively, it is an indication for the business or the organization to take a call on whether they would want to continue their production or not, right? So total revenue, total cost can indicate your position in a business by showing you either you are earning profits or you're making loss. And earning profits and making losses are the basis of your future decisions. Normally, when businesses decide to expand, or businesses decide to keep on investing more money as inputs, it is based on profit value, that is total revenue exceeding total cost. But if the reverse happens, right, I'm sure as you will proceed in the course, you must have learnt about strategic decision, right? Why I'm telling you here? Because this unit has a very important implication in how does this apply to managerial understanding. So rather than waiting till the end to give you all the examples, I am incorporating the examples now and here, so that you can understand and link it to how you use it for your strategic decision making. So when I talk from the concept of total revenue and total cost, it might be very, very essential and crucial for any manager to understand this position for the organization, because it is going to answer the question, where in the strategic grid is your organization's product falling? So it could be, normally we see it on the BCG matrix, right? So you must have heard about stars, dogs, question marks, cash cows, right? So normally the first perspective, there are other perspectives to look through it. There is market share as well. But from an economic perspective, the first thing that we look at is whether it is a profit making unit or whether it is a loss making. So that will decide within the grid where you need to position your product and what further decision you want to take on it. Okay. So though this is just the start, but I'm also trying to give you the managerial implications here, so that towards the end we don't have a lot of pile up to discuss. Okay. Now, understand the concept of opportunity costs. Now, if you recall from our previous discussion, I told you opportunity cost of time. Okay. So, what does it imply? It implies that if I have to take a decision, right, of saving my time, and to save that time, I may have to incur some additional cost. As a rational consumer or as a rational individual, I would take that call, right? What would I do? I would think, okay, let me pay a little extra if it implies that I save some money. If it implies I save some time, and this time is actually my opportunity, right? Now, when we think from the perspective of costs, also, it is important to keep in mind the concept of opportunity cost. Now, what is opportunity cost? Opportunity cost is the cost of something which you gave up, right, to get another option. So, like I gave you an example, just imagine after your MBA, you get two opportunities to work for two different organizations. One allows you to have a higher salary, but they have extensive travel for you. The other one maybe gives you a little lesser salary, but there is no travel involved, and the working hours might be comparatively lesser. Right? Now, if you choose option A with some X salary, right, over option B with some Y salary, Y becomes your opportunity cost, because that is the cost of the next best opportunity if you would have not chosen opportunity A, right? Similarly, when we talk from the perspective of organizations or companies making decision, at every cost, at every step, as cost decision, the manager has to understand what is their opportunity cost, and is that opportunity cost worth giving up for the option that they have chosen. Okay, the owner of Ford Motors. Okay, and as Henry Ford, because you are the owner, so as Henry Ford, you have to decide who will you procure the raw material from. Obviously, you are making a finished car or you are assembling a finished car, right? Now, one of the supplier is me. Say I am one of the supplier, and I am little away. For example, wherever your factory is, my factory's location is almost 1,000 kilometers away. Okay, but the cost at which I'm willing to give you the raw material is, say just giving an example, say 1 lakh rupee for 10 units. On the other hand, there is an individual X, okay, who is closer to your own factory or your own workshop. This individual has similar raw material that you need, but he is charging you 1,15,000 for the raw material. But the advantage that is there with him is that he is little closer. So I am 1,000 kilometer away. He is only 250 kilometers away. Which of the option will you choose? Me or the individual X? Just giving an example here. Suppose you choose me, okay, over the other individual, considering the fact that if you multiply it by the number of times you procure, you feel maybe the cost of procurement from me is lesser in terms of even paying for the additional transportation. So here, the 1,15,000 rupees amount that you left to choose me is your opportunity cost, right? What does it mean? It means that if I was not an option for you, you would have chosen that individual. right? However, opportunity cost concept will always come when there are more than one options for an individual or for a supplier or for a manufacturer to choose for, right? And if you decide to choose him over me, right, so your opportunity cost becomes 1 lakh rupee, because that is the amount that you have foregone, right? You have left that amount to ensure that the delivery of the goods happens in time, and you feel that, paying little additional for transportation is worth it, right? So this is how we see the concept of opportunity cost in managerial decision making, right? Now, whenever a firm has to make, or or a manager has to make, from economic perspective, he needs to make a decision. He should always include what are the different opportunity costs. Now, once you have the various opportunity costs listed in front of you, it is there, and then, you know, you can actually choose and decide which one would you want to pick and why, right? And opportunity cost is also important because in the absence of first option, right? What if you choose me, but because of whatever reason, I'm not able to fulfill your orders on time, and now you have to look for other option. Now, looking for a new option at that point of time can be both time consuming as well as high cost option, because you'll have to stop your production, you'll have to, pause so many of your processes. The other option is just simply pick up your register where you listed your opportunity costs and just check, okay, who was my second best alternative, and choose that individual, right? So if you see from that perspective, also from a strategic perspective, this has relevance in the long term. Okay. Now, on the basis of costs, okay, we try to break up the economic and accounting profit. Now, I am sure you all know that, economic cost and accounting costs are two different things, right? And economic and accounting costs cover a lot of, perspectives, or they cover from a broader domain. What we try to imply from calculating whether we should continue a business, are we making huge profits, are we making nominal profits, etc. Right? Now, when we have to define economic profit implies the total revenue minus the total cost. This includes both your explicit as well as implicit costs, right? Now, what is explicit and what is implicit cost? I am sure you all remember from our previous discussion. Explicit costs are those costs which you can list down in your book of accounts, right? For example, the salary, the rent, all the raw material procurement cost, etc. But implicit costs are those intangible costs which you cannot, extensively list in the book of accounts. For example, as a business owner, you bring in your own expertise, but you don't take any money or salary for that, right? So your expertise, your knowledge, your experience, your time, these are all implicit costs. Now, in economics, when we calculate profit, we take into account the total revenue minus the total cost, right? Now, this will include both your explicit as well as implicit costs. However, in accounting profit, we only take the revenue minus the total explicit cost. Whatever is recorded in your books of account, only that cost is considered in your accounting profit. Whereas in your economic profit, we include both what is listed in the book of accounts and what may not be listed in the book of accounts. So, for the same organization, you may see two different values for profit, one for economic, the other for accounting, right? And the reason being, accounting profit might have a little higher value over economic profit for the simple reason that in the economic profit, we have also considered the implicit cost, which we did not cover in the accounting profits. Okay. And that could be one of the reason, why businesses, when they make their calculations based or decisions based only on accounting profit, they can go wrong, right? Sometimes only accounting profit will give you a positive picture and will encourage you to take a different decision. But when you think from the economic point of view or the economic profit perspective, you will come to know that, for organization, you left an important concept, that somebody's expertise, somebody's knowledge, somebody's, own experiences has come to your organization free of cost, but they are not actually free, right? So if I'm investing time in doing something, even my time has some value, right? But this is not considered in accounting, and that is why accounting profits and economic profits can have two different values. Okay. Now, when we look at the various measures of cost, we consider the fixed costs, variable costs, average fixed and average variable costs. Now, what are fixed costs? Fixed costs are those costs which do not vary with the quantity of the output that you produce, like your rent, right? So whatever area you are starting your business in, you have to pay a fixed rent. Now, it might be possible that you may produce a lot of units or you may not produce anything at all, right? But that does not matter in fixed costs. Fixed costs are those costs which you will have to pay whether or not you are making any production, and it also will not vary with the number of units produced. So if I'm paying 1 lakh rupees rent and I'm running my machinery for making 100 units, even then I have to pay the rent as 1 lakh. If the same area I am using for making 20,000 units, then also my rent remains the same. So with the change in the quantity of output produced, my fixed cost does not change. However, what changes is known as variable cost. Now, this will vary with the quantity of output that you are producing. So, just for example, when I was making only 1000 units, I required lesser raw material. Okay, maybe for even labor also, I did not require contingent labor, I did not require contractual labor. I was having fixed 10 people who could do the work. But now suddenly I've got a bigger order for 20,000 units, and to make those 20,000 units, I will have to buy more raw material. I may have to, employ more people, right? I may have to spend more on electricity and running cost of my machinery. So, with every increase in the quantity of output, what happens is your variable cost goes up. All right. Now, what is average fixed cost? Average fixed cost is the fixed cost which is divided by the quantity of output. So, for lesser unit, you will have higher fixed costs. For more units, your fixed cost will start coming down. So when I'm making 100 units, your average fixed cost will be, say, if you're spending 1 lakh rupees, so 1 lakh divided by 100. But when I'm making 20,000 units, my fixed cost will become 1 lakh divided by 20,000, right? And variable average variable cost is the variable cost divided by the quantity of output. Again, when I'm making 20 units, whatever variable cost I'm incurring, I'll divide it by 20. When I'm making 20,000 units, I will divide the same value by 20,000. So you will see with every increase in the denominator, that is the number of units that you are uh, producing as output, both your fixed and average cost will, sorry, both your fixed and variable cost will start coming down, right? I hope this concept is clear. Okay. Moving to the next concept of marginal cost. Marginal cost is an important concept, like I told you, that why marginal cost may be important, because for any business, right? Uh, it is important to know that if I make more than what I'm making, even if I make just one more unit additional to what I'm making today, what is the cost that I'm going to incur on it, right? So, it marginal cost is the increase in the total cost by producing one more additional unit. I'm so sorry. Marginal cost formula is given as del TC divided by del Q, which is total cost divided by the total output. Okay. Now, why do I want to have this value, or why is it significant for me? Now, when I'm understanding the concept of economies of scale, does anybody have any idea what economies of scale is? Economies of scale. Okay. Now, assuming I am making today, I have a machinery, okay, and I am making, say, 1 lakh units on this machinery today. Now, is it my most optimal output? How would I know that? Is there a method to know it? That is it my most optimal output, or can I make more? The best way to know this is by the concept of marginal cost, right? What is optimization? Optimization is a simple action, right, where we ensure that we make the best use of our available resources. So now I have available resources and I'm making 1000 units, but I don't know whether I'm making best use of them or not. The best way to know this is to increase your production marginally. Maybe instead of 1000 units, let me make 1005 units. Now at 1005, what is the cost of my production and what is the optimal level of output and profit that I'm seeing? Further, let me increase it by 10 more units, right? Then maybe by 5 more units. So it might be possible that at 1050 unit, I come to know that this is the most optimal output level for me to produce in one cycle when I run my machinery. Anything below this means I am spending more on my inputs. Anything more than this might mean that, I might be having a lower cost of production, but my machinery and my other resources are overutilized. So I don't want to go overutilized and I don't want to go underutilized. With marginal cost, I can understand that what is my margin cutoff, right? Or the minimum number of units that I should keep on producing, right? To ensure that I am reaching my optimal output level, right? So okay, somebody in the long run would want to know, why is it so important? What is the loss even if I'm making 1000 units only? Or what is the loss if I'm making 1100 units instead of 1050? So I'll tell you. When you are making lesser, right? If you're making 1000 units, right, only, in that case, maybe the cost that you are spending is significantly higher than the revenue that you can generate. And you are still having some resources which may not be doing any work at all. Now, there is a very interesting game concept. I can quickly give you an example. Now, suppose, just understand, I own a restaurant business. Okay. Now, in this restaurant, I am selling maybe say three variety of dishes, which could be Indian, continental, or Mediterranean, or something like that, Asian, Pan Asian, any three. Okay. And here, the footfall for the day that I calculate is maybe around at least 50 people come to my restaurant daily, including the entire day operations. Now, I have installed some tables where people sit. Okay. But I realize that when I have only five waiters together working at one point of time, some of the customers are dissatisfied because they are waiting to be served and there is no one to take their order because all my waiters are busy, right? Now what has happened, I have the resources, I have the space, I have the table, I have the machinery, I have everything, I even have customers, but the problem is I don't know what is the optimal level of people I should employ to serve everybody and to ensure people are happy with my service, right? So at this stage, or in this case, marginal concept will tell me that you should employ one more waiter. So I employ one more person. Now, after employing one more person, I realize that there is still shortage. Okay, there are still customers who come for on delivery orders, and there is nobody to pack for them, or there is nobody to attend such customers who only come for orders, right? Takeaway orders. So then I put one person into takeaway orders, and now again realize that there is one individual less on floor again. So this time what I do, I employ two people instead of one, right? So from five I increased to six, and from six I increased to eight. Now with the eight-person employed, I realize that always during the day there is at least one person who is free, who is not doing anything, who is sitting idle, right? That means somewhere I have over hired people and I need to reduce. Now, how did I know this? I know this because with every marginal unit, I was calculating my cost, my margins, my optimized output, and I was understanding that whether or not I require individuals. So then I decide that, okay, I genuinely only need seven people. I may not need six is less, eight is more. At eight, I was doing overutilization of my resources, and at six I was doing underutilization of my resources. So seven is the most optimal number. And how did I get this? With the concept of marginal output, right? So when the question arises that why marginal cost might be important, okay, now I have a question for you, and you may think and just rationalize this. There is a farmer, right, who is rational. Farmer Jack is a rational individual, and he wants to maximize his profit. Now, to increase the profit, should he produce more wheat or should he produce less wheat? Now he has to answer this question. Okay, that I am I let me think from a rational perspective, because if I will be overproducing, what will happen? Maybe my cattle will fall sick because they are very tired. My harvesting machinery might not work properly because of the more wear and tear, running it for longer time, or it could also lead to uh, frequent breakdowns of the system. And when I'm producing less, maybe I realize that there is a very long duration for which maybe my cattle is settled idle, or there is a very long duration of time for which maybe I am creating lags to make my product reach the market. So how should I take this decision of whether I should produce more or produce less? Now think from the marginal perspective. Okay, to answer this question, he needs to think at the margin. Now, if the cost of additional unit of wheat, that is the marginal cost, is less than the revenue that he is going to get by selling it, then his profits rise if he produces more. On the other hand, if the additional wheat, right, is more than the revenue that he would get from selling it, then his profits will not rise if he produces more. So then, if the value of marginal cost is less than marginal revenue, then you should go and take the decision of producing more, or maybe hiring more people. If the value of MC is more than the value of MR, then you should not take the decision, and maybe you should look at how you can reduce those units. Okay, this is how you, and most optimal decision is where MR is equal to MC, the marginal revenue that you would get by selling that additional unit and the marginal cost that you incur to uh, manufacture, produce, or procure in any cycle, that raw material or that additional input. Then you should take a decision of going ahead with it. So MR is equal to MC is the optimal value, right? MR more than MC is the value of profit, and MC more than MR is an indication of loss. Now, it brings one important concept of the costs in the short and the long run. Okay. Now, we know that within the short run, we have two types of variables, that is the fixed cost and the variable cost. However, in the long run, there is no fixed cost, all the costs become variable. That is the principal concept which we consider when we want to understand the costs in the short and the long run. And the differentiating factor in both short and long run happens to be the concept that there is no fixed cost in long run. However, short run has the concept of fixed cost. Now, when we take short run, we say some of the inputs can be broken up as fixed, the other can be broken up into variable. Now, when some inputs are fixed inputs, right, we categorize them as factories, land, you know, any area of operation that you have. Now, these are going to be fixed, right? So, if you have to start your business within that setup, in the short run, you will not plan of expanding your land or your factory size, right? In the short run, within the given factory size, you can only increase or decrease your variable input to make more or less of what you want to make. Now, the cost of these inputs, which are fixed, are known as fixed costs. So, whatever rent you are paying for your land, right, or whatever size of factory you have and the cost involved to run that factory becomes your fixed cost. However, in the long run, all the inputs become variable, right? There is no fixed input like factory or land, because in the long run, it may be possible that if I'm making profits regularly, I may even, plan to expand and acquire more nearby land. I can plan on buying more machinery, right? And expanding the size of my factory and so on, right? So all the inputs become variable. Why? Because the firm can build more factory or can sell the existing one and acquire a bigger space or bigger factory. Now, in the long run, the average total cost at any quantity, right? Q represents the quantity, ATC is the average total cost. Now, within the long run, the average total cost at any quantity is the cost per unit using the most efficient mix of inputs for that Q, right? That is the factory size with the lowest ATC, average total cost. Okay. Now again, this brings me to a question that how do I know that whether the land that I have acquired or whether the factory that I have installed, is it sufficient enough to fulfill my output? If not, when should I take the decision of expanding it? If expansion might not be my most budgeted decision right now, what should be my most budgeted decision? This is where the concept of, the costs in the short and long run will be applicable. Now, when we take the long run average total cost with three factory sizes, okay, now this is a graphical representation. Just understand, take some time, absorb it. I will go very slow on this so that you people are not confused. Now we have three options from three factory sizes: small, medium, and large. This is, just to give you an example. Obviously, factory sizes are not SM and L. I am only taking this so that I can, give you a reference and make you understand. Now, suppose you have three options to choose. Okay, today you want to start your business, and to start this business, the first question you need to answer is, what size of factory should I take? Now, the available size options that you have currently are S, M, and L, that is small, medium, and large. Now, each size has its own SR/ATC curve, right? This is your ATC curve, average total cost curve. For the size S, right? I'll use the highlighter. Yes. For the size S, this is your average total cost curve. For the size medium, this is your average total cost curve. And for the size L large, this is your average total cost curve. Okay. Now, firm can change to a different factory size in the long run. Always remember, today when you are starting your business, you are still in the short run. Okay. Now, in the short run, you don't have an option to change the size of your factory or to just acquire the land that you feel that, okay, I want to produce more, and today I just started and maybe 10 days down the line I want to acquire more land. That is not possible. Okay, so in the long run it is possible for you to change the size, maybe from bigger to smaller or from smaller to bigger, but not in the short run. That is a very important thing that you have to keep in mind. Now, just understand. Suppose when you are considering your average total cost curves for small, medium, and large size, all these three sizes, understand the quantity of units that you are going to make, right? For example, what is the output? When your output is at quantity A, right, which is the most optimized, option to choose, which is my lowest average total cost option. So if you see with quantity A, it is the lowest here in the size small. But when you expand your quantity and you think that, okay, this is the minimum quantity that I'll be selling from day one, then you will see that it will move to the medium size, right? This happens to be the only option because this is the most optimized option. Now, to produce less than QA, the firm should obviously choose size S, right? In the long run, to produce between Q and B, QA and QB, you should choose the size of option uh, M, that is medium, even in the long run. But anything which is beyond QB, right? If you have to make anything beyond QB here, this region, you should choose the option of going for L, right? This is how the firms normally make their decisions. So most important thing for you is to judge yourself for yourself, that what is the minimum output units that I'm going to produce in maybe this much duration of time. If that value falls within the region QA, you should choose for small size. If it exceeds A but falls less than region B, go for medium size. But if it extends beyond B, go for the larger size, right? In the long run, I'm talking about long run, please be mindful, not for the short run. In the short run, normally every business starts with S because they don't know their most optimal size and they don't know the longevity of their business, right? So when we talk about a typical long run average total cost, LRATC, right? LRATC is long run average total cost curve. This is how it will move. Okay, let me help you see the transition. Okay, can you see how it moves? So in the real world, factories will come up in many sizes and each will have its own short run average total cost curve, SRATC curve, right? ये factory one है, this is factory two, factory three, factory four, and so on, right? So when we are moving like this, factory one, two, three, four, five, six, 7, 8, 9, 10, 11, right? So we have seen 11 different short run curves. But a typical long run average total cost curve will be looking something like this. And how has it come? Just see, it is, joining every intersection point of the previous curve, right? So the between this curve 1 and curve 2, this is the point of intersection where we take one point. Between the next two, it is this, then this, and so on. So this is how we get a U-shaped long run average total cost curve, right? So this is how typically it may move, right? So as your scale of production expands over a period of time, obviously, because when we are talking profits, when we are talking business, we always see that person is going to expand, right? No business is going to operate if there is no expansion or if there is no chance to earn a profit, right? So this is how typical an average total cost curve might look like. Now, the very important question of economies of scale. I told you that when we are starting a business or when we are, acquiring some inputs for production, one important question that we answer is how do I get my economies of scale, the most optimal output level at which my profit is maximized. Two things happen, okay? My profit is maximum and my wastage and cost is minimized, and at this point I am making the most optimal utilization of all my resources. No resource is getting overutilized and no resource is getting underutilized, right? Even for decisions like should I hire more people, or should I buy more raw material, or should I plan and expand into some business space, and so on, right? The simple question of economies of scale needs to be answered. If your economies of scale is falling short, you should fill that gap. If it is falling beyond, you should reduce that gap. So this answers the question that why there are layoffs, right? There might be layoffs because it is exceeding your economies of scale. So if it is exceeding your economies of scale, it is an economic decision. You are wasting money. So what companies do, they realize that okay, these are the positions where they have more number of people than the work required. So it is better that we lay them off. So layoffs also happen, right? When economies of scale falls short. So today in my business, I realize that okay, there is so much of work, but I have so less of people doing it. So I at least need five more people to be able to achieve my economies of scale. I will hire more people. So hiring, firing, layoffs, etc., most of them have their answer in economies of scale. As managers, when you will be in a position to take these decisions, you will realize that, it sounds simple and it sounds very suggestive when you have to, tell somebody, why didn't you do that or why didn't you do this? But when we look from rationalized economic perspective, we have to take tough decisions, right? And some of the basis of the tough decisions simply lie on how economic are your decisions. So economies of scale, right, is important point of view that organizations take into consideration. Okay, sorry, I forgot. I was supposed to tell you this concept. So always remember, like this curve is moving, right? The returns to scale also moves like this. When you start, you have decreasing returns to scale. Now, what does decreasing returns to scale means? That your cost per unit is high in this region. Till this region, you have calling returns to scale. That means you are spending more on input, right? But which is not getting covered optimally by your output. Okay, so what should you do? You should keep producing more. From here, you move into the next region, which is constant return to scale. That is, ATC stays the same. Here, what happens? The cost that you put and the output that you get both become equal, right? So this is the region from where the business will start to grow. Okay, this region. Constant returns to scale. This is diminishing returns to scale. This is constant returns to scale. And finally, when you keep producing more units, what will happen? Your denominator will increase, but your numerator will remain constant. And as a result of this, what will happen? You will get the average total cost will start to increase again, right? And you will get higher returns to scale, but here you will you will have diseconomies of scale. Okay, now understand, returns and economies are inversely related. Whenever you have economies of scale, your region of diminishing returns and constant returns is a preferable region to operate into, because by that time you are getting economic utilization of your resources. If you continue to manufacture beyond, it will get into the region of diseconomies of scale. So, though you may be seeing higher output, though you may be seeing more units getting produced, but those units are actually not making any economic profits to you, right? So, this answers the question of how much should I produce? Always produce till you stay within your constant return to scale region, because anything beyond this will cause your ATC to rise, right, as your quantity will increases, because this is long run. In the short run, it is different. In the short run, it is always economic to continue, because you know your fixed cost will remain same. But here, no cost is fixed cost, all cost is variable. So with every increase in output, your ATC will also increase. So be mindful, right? This is the region of diseconomies of scale. Okay, moving ahead. Now, how the average total cost changes as the scale of production changes, right? Now, economies of scale will occur when there is increasing production, which allows greater specialization. Workers become more efficient when focusing on a narrow task, and this is more common when the quantity is low, right? So, this is a simple example, the restaurant example that I gave you. Okay, now just imagine if lesser customers come to the restaurant, right? The waiters will not be in a hurry, right? And they'll be able to serve each customer with more I would say with a better grit, more patience, and in a manner where there are no spillovers, there are no confusions, there is no lag times. Just imagine now what happens when customers increase, right? What now suddenly what happens? There is a pressure on waiters also. Everybody is calling for their orders. Why is my order not delivered? Why have I not got this? Can you take another order? And because of that rush, right, you will see that their specialization will not allow them to focus on any task, and there are higher chances of errors. I have taken example of service because it is easy to comprehend in products, but this applies to services as well. This is an example of service. Now just imagine you go to your barber and he has a rush of customers waiting. You will see he might be very disinterested and he might be in a hurry, right, to ensure that he attends to more number of people. And in that rush, there are higher chances that it can lead to misses, right? Now, what kind of misses can it lead to? It can lead to, misses like whatever the customer has asked for, the delivery is not complying with it. The another miss that can happen is that within a hurry, it might be possible he might hurt somebody, or it might be possible that some customers who were his regular customers, they become displeased and they don't return to him, right? So it even applies to services, right? Now, diseconomies of scale are due to the coordination problem in larger organizations. So, like I said, sometimes the product might be fine, but your services, your integration, and all, they might be facing the problem of diseconomies of scale. I'll give you a simple example. Now, today you are attending this session. Okay. Now, this is economics, and this requires you to, concentrate a lot, focus a lot. Now, within the same time, you are also told that after this session ends, you will have to appear for a test in, say, accountancy or any other subject which requires a little more intellectual and complexity of thought. Now, in that case, you will realize what will happen is you will neither be able to focus here nor will you be able to perform well over there. And this is exactly why we focus that specialization is of high relevance or importance for organizations, right? And normally, when does this happen? When the Q is very, very high, the value or quantity of output is higher. Now, when the scale of production changes, right, we should also be mindful of how, organizations make their decision. Now, this brings us to the theory of production. Theory of production talks about how production involves transformation of your inputs like the capital, the equipment, the labor, and the land into some outputs which could be in the form of goods and services. Now, in this process, the manager is more concerned with the efficiency in the use of inputs, that is, technical versus economical efficiency. On paper, it might look like you are most efficient, but when you talk to your people, they will tell you we are very tired, we are stressed, we are fatigued, we may not be able to comprehend, we are not able to think well, right? So your technical and economical efficiency can also vary at the same point of time. Now, there are two concepts to efficiency. One is economic, the second is technological. Now, economic efficiency occurs when the cost of producing a given output is kept as low as possible, right? For economics, what is it? It is about how can you reduce your cost of production. So, if your cost of output is kept as low as possible, you are economically efficient. Right. And technological efficiency occurs when it is not possible to increase the output without increasing the inputs. Now, just I gave you an example of books yesterday. Right. Now, suppose in books, in case of books, right, what may happen if somebody is asked to write a book by hand, they will take more time. Right. So economic efficiency might say that you have 10 people who are writing books by hand, so in a day maybe one person can write some few pages and in 5 days they can write one book. But suddenly what happens is your demand goes up, the demand for your books goes up. Now here, even if you hire more people, they may not be able to fill the demand. So, in order to achieve that efficiency through technology, it will only be possible to increase your output when you increase your input by maybe buying a machine or buying a printing machine that can print maybe thousands of copies of one book within one day. And only then will you be able to optimize your output, right? Now, you will see that the basic production theory is simply an application of the constraint optimization, right? Optimization is a very constrained concept, right? It says that always and always choose the most efficient option, and efficiency can be defined in terms of, how economically viable or how economically well are your resources performing. So the first attempt either to maximize the cost of to minimize the cost of production at a given level of output or to maximize your output attainable within a given unit of cost. There are only two options, right? Either you produce at low cost or you produce more at the same cost. Through any one of this, you can achieve optimization, but the optimization problem lead to the same rule for allocation of inputs and the choice of technology. Now, while you choose any one of the option, either you will have to, check for your efficiency, or you may have to check for more resource input through technology or other things. So, if I force my people to write books faster, their handwriting might not even be eligible, right? There might be more rejections. It might be possible that some of them might have got tired and sick of doing this work and they may decide to quit, right? So if I choose, minimizing the cost of production, it can create its own problem. And if I choose to maximize the output at the given level of cost, what I do, I ask five people to leave, and instead of those five people, I get just one machine. Right now, this one machine, though it is doing more work than five people, but it is also, incurring some higher cost. So I have to make a choice whether I choose option one or I choose option two. But in both, I will always be forced to choose between optimization. And optimization is a very, very complicated problem. Okay, it is not easy for businesses to take a decision on this overnight. It's a long thought process, very strategic in nature, and there are multiple factors that work around to take this decision. Now, in the short run and the long run, just understand when we differentiate. In the short run, some inputs are fixed and some are variable. Example, the firm may be able to vary the output of labor but cannot change the amount of capital. And in the short run, we can talk about factor productivity, law of variable proportion, or the law of diminishing returns. Right. So what we saw was law of diminishing returns, right? And how do they apply to businesses? I told you that it will have reverse effect. You will think that you are getting more output, but it might actually be unsystematic output. That means it is not being very useful or it is not being very optimized for your business. Now, in the long run, all the inputs become variable. That is, the long run is the period in which the firm can adjust to all the conditions, be it land, labor, capital. So we can talk about more focus on returns to scale. Now, important concept of efficiency in production. We'll talk about, a coefficient with respect to B naught. Now, B naught is what? B naught is, there is a hypothesis which says that should I choose option A or should I choose option B? Now, if two firms, just understand, okay, if two firms have the same factors of production, okay, and within that same factors of production, they still produced different quantities. Okay, factor of production is the same, but the output by both the firms is different, right? Now the difference can be due to factors which are not related to cost but which are related to intellect. It might be possible that in firm A the manager is more knowledgeable, he has better understanding, his entrepreneurial skills and decision making skills are better, and with the same level of input he is able to make better planning of resources, while the person in the organization B, he might not have that well thought or well organized process decision making, and as a result of this the output in that organization is less, right? So efficiency of production is one thing which is very important when we answer the question of competition, right? When two firms are given same type of resources, why one may perform better than the other? Simply because of the entrepreneurial skill of one being better than the entrepreneurial skill of the second one. Okay, so this technically can even answer the question as to why and how should I make my hiring decision, or who should I choose to hire. Okay. Now, the last concept that I want you to understand, as consumers, you already know this, but I still thought I'll give you a brief here, that there is an indifference curve, right? And there is an analysis that we do on the basis of indifference curve. Now, what is this indifference curve? An indifference curve is what it is. It is a curve that shows you a combination of the two goods in various quantities that provide equal satisfaction to an individual. It is used in economics to define the point where individuals have no particular preference of either one good or another good based on their quantities. Okay, let me show you this on a graph to make it more comprehensive and more understandable. We are taking two goods, hot dogs and hamburgers. Okay, now you have some income, you have certain X amount of money. You go out to shop, and while shopping, you realize that you like both hamburgers and hot dogs. The cost of hamburger is maybe say 10 rupees, and the cost of hot dog is 15 rupees per piece, right? Now the best rational decision is that you will buy some from both rather than spending all your money on hot dog or spending all your money on hamburger. As a rational consumer, you will choose to achieve a balance between the two, right? Now there are various combinations of balances. You can choose to buy 14 hamburgers and with the left, sorry, 14 hot dogs, and with the money that is left, you can buy 20 hamburgers. Or you can buy 10 hot dogs because you like hamburgers more, and with the remaining money, you can buy 26 hamburgers. You can even reduce the hot dogs to 9 to buy 41 units of hamburgers. But at all these points, A, B, and C, your level of satisfaction remains the same. So by buying 14 hamburger, sorry, 14 hot dog and 20 hamburger, you are as happy as you would be if you were buying 10 hot dogs and 26 hamburgers, right? This is exactly the concept of indifference curve, right? It tends to answer the question that why and how do people make their decisions of dividing their resources between all available sources, right? And normally, when you go and make your purchases, this is the basis on which you make your decisions, right? Now, costs are very critical to business decisions, including the pricing and hiring. Like I told you, right? Should you hire more people? Should you not hire more people? All those decisions. Marginal cost is important concept because the additional cost per unit is usually upward sloping and can answer the question as to uh, whether or not you should keep on making new units. Average variable cost is the variable cost which is divided by the total output. Fixed cost in terms of average fixed cost will be the um, division with the number of output. Average fixed cost curve always falls at as output increases. And average total cost is also called sometimes the cost per unit and is the total cost which is divided by the quantity of output. It is usually a U-shaped curve.